There is a sea of opportunity in the financial markets, with a chance to make your money work for you. FTEC and FSPGX are the two funds we will be comparing today. Now let's get cracking. Investing can seem like a game of Monopoly, but with real money at stake. Let's break it down. Imagine end balance as the total cash left when the game ends. As you dollar cost average over time, you build to a sizable position. If you use Portfolio Visualizer, you would see that FTEC, with a whopping $528,799. Compound annual growth rate, or CAGR, is like the rate at which your monopoly empire grows every year. FTEC again shines with a CAGR of 66.86%, meaning it's expanding super fast. Now, time-weighted rate of return, or TWRR, is like your score, regardless of when you bought properties or collected rent. And money-weighted rate of return, or MWRR, is your score considering when you made those moves. Guess who's winning again? Yep, it's FTEC. So, investing isn't rocket science. It's about understanding the game and playing it smart. Now that you're familiar with the lingo, let's see how our three funds, FTEC, FSPGX, and SPDR S&P 500 ETF Trust, have performed. Imagine the funds as three athletes, each with their unique strengths and weaknesses, competing in a triathlon. First up is FTEC, the powerhouse of the group. With an end balance that would make even the wealthiest of tycoons blink twice, it's the Usain Bolt of our little financial race. A compound annual growth rate, or CAGR, of 66.86% is nothing short of a sprint. Next up is FSPGX. While not quite as speedy as FTEC, it's no slouch either. It's the marathon runner constantly on FTEC's heels, boasting an end balance that's not too shabby and a CAGR of 63.86%. Steady and strong, it's a good bet for those who prefer a less risky race. Bringing up the rear, we have the SPDR S&P 500 ETF Trust. Don't let its third-place position fool you. This fund is the tortoise in our hare and tortoise tail. With the lowest end balance and a CAGR of 61.10%, it may not be the fastest, but it's reliable and steady. But remember, in the world of investing, high returns often come with higher risks. It's like attempting a high jump. FTEC, with its high returns, is going for the gold, but the risk of a fall is greater. FSPGX, on the other hand, aims a little lower, reducing the risk of a tumble. And SPDR S&P 500 ETF Trust? It's taking the safest jump possible, ensuring a steady landing, albeit with less of a wow factor. So who's the winner in this financial race? That depends on your appetite for risk. If you're the type who enjoys a high-speed chase with potential for big wins, FTEC might be your champion. If you prefer a steady jog with fewer surprises, FSPGX could be your pick. And if you're all about that slow and steady pace, SPDR S&P 500 ETF Trust might just be your tortoise in shining armor. Remember, in the world of investing, high returns often come with higher risks. Risk and reward, two sides of the same coin. Let's dive into some key terms that help us assess these two aspects of investing. Standard deviation measures volatility. How much an investment's return can vary from its average return. It's like a roller coaster ride. The higher the standard deviation, the wilder the ride. For instance, FTSE, with a standard deviation of 20.46%, promises a thrilling ride with high peaks and deep troughs. Next, we have maximum drawdown, which measures the largest drop in value from a peak to a trough. Imagine standing on top of a hill and then sliding all the way down. That's your drawdown. The larger the drawdown, the steeper the hill. Here, FTEC again tops the chart with a drawdown of 26.54%, indicating significant potential losses during downturns. Now, let's balance the scales with some risk-adjusted returns. The Sharpe ratio gives us an idea of how much return we're getting for each unit of risk taken. A bit like asking, how much bang am I getting for my buck? With a Sharpe ratio of 1.04, FTEC seems to be providing more bang for your buck. Then there's the Sortino ratio, which only considers downside risk. FTEC leads again with 1.74, suggesting it provides high returns with relatively lower downside risk. Investing is all about balancing risk and reward. It's not just about the potential for high returns, but also about how much risk you're comfortable with. So, which fund is the best choice? This is the question that's been hanging in the air. To answer that, it's essential to look at the whole picture. FTEC stands as the high performer, with impressive growth and returns. It's a choice for the aggressive investor, ready to embrace the roller coaster of high volatility for those peak returns. Then we have FSPGX, which strikes a balance. It offers solid growth without the extreme swings of FTEC, a middle ground for those looking for growth, but with a bit more stability. SPDR S&P 500 ETF Trust is the steady player, offering the most conservative option. It's ideal for the risk-averse investor who prefers a smoother ride, even if it means slightly lower returns. Remember to subscribe for more content. In the end, the best choice isn't always about chasing the highest returns. It's about finding the investment that aligns with your financial goals and risk tolerance. Remember, in investing, the best choice isn't always the one with the highest returns, but the one that fits best with your financial goals and risk tolerance.